Welcome back to the deep dive. Today we're going to talk about a company that you probably think you know pretty well. I mean, you likely have their app on your phone right now. You've definitely seen their delivery cars in your neighborhood.
Oh, absolutely. Everyone knows the logo.
Right. But if we're being completely honest, when you think of this brand, you think of, pepperoni, those square cardboard boxes, and maybe a garlic dipping sauce.
It's an iconic image, but if you actually look under the hood at what's driving it, what we are really talking about is a high-frequency logistics company, one that just happens to finance all its technology by selling melted cheese and dough.
I really love that framing. And yes, we are talking about Domino's Pizza today. The reason we're diving into this is that it is Monday, February 23, 2026, and they just dropped their earnings.
Yeah, the results for the fourth quarter and the full fiscal year of 2025.
And look, usually earnings calls can be a bit dry, but this one, it really felt different. There's just so much noise in the fast food world right now.
Totally. Prices are up, stores are closing left and right.
Yeah. Right. You hear people saying fast food is dead constantly. Our mission today is to unpack how a very mature pizza chain is managing to not just survive, but actually grow in what they call a challenging macro environment.
It's a very weird moment for the industry. You have these massive legacy brands shrinking, but then you look at this report from Domino's, and they seem to be living in a completely different reality.
So we've gone through the Q4 press release, the financial statements, and we have the full transcript of the earnings call with their CEO, Russell Weiner, and their CFO, Sandeep Reddy.
And we are going to figure out what their specific strategy, which they call Hungry for More, actually looks like in practice.
Let's just start with the elephant in the room. The big narrative out there right now is that the pizza party is over.
Right. The category is supposedly dying.
Exactly. We've seen competitors, big national chains, announce they're closing hundreds of stores. I think one of their main rivals just recently said they are shuttering up to 250 locations.
That is correct. Up to 250 stores. And in the world of QSR, quick service restaurants, which is just industry speak for fast food, when a major player closes that many stores, it's usually a giant red flag.
It means the unit economics are totally broken.
Right, precisely. It means those individual stores aren't bringing in enough cash to pay the rent and keep the lights on.
But then Domino's comes out today and basically says, actually, we're doing great.
Better than great. Let's look at the big numbers. Global retail sales grew 4.9% in Q4, excluding foreign currency impacts. And for the whole year, they were up 5.4%.
Wow. And in the U.S., same-store sales were up 3.7% for the quarter and 3% for the year.
Yeah, and here's the really wild contrast to that competitor we just mentioned. In 2025, while others were retreating, Domino's opened 172 net new stores in the U.S. alone.
Net new, meaning openings minus closures.
Exactly. And globally, their net store growth was 392 just for the fourth quarter and 776 for the entire year. So while the competition is boarding up windows, Domino's is out there pouring concrete.
Russell Weiner, the CEO, he actually seemed to take that whole pizza is dying narrative a bit personally on the call. He was pretty aggressive about correcting the record.
He really was. He basically told everyone to look at the data.
Yeah.
There's this false narrative that the pizza category is declining, but Weiner argues that's just not true. The category has actually grown about 1 to 2% annually since 2019.
Oh, wow. So if competitors are seeing their sales drop, it's not because people suddenly stopped eating pizza.
Right, it's because they stopped eating their pizza.
It's just a massive market share grab.
It's a classic winner-takes-all scenario. We're talking about being the #1 in net store growth among public QSR brands with over 3,000 units. Domino's has gained approximately 11 points of market share over the last 11 years.
11 points is huge in fast food.
It's massive. When a rival closes a store down the street, that consumer hunger doesn't just evaporate. Those Friday night orders have to go somewhere, and Domino's is absorbing that demand.
Okay, so they are the vacuum cleaner, picking up all these displaced customers. But here's the part of the report that completely threw me. We all know inflation is still a major thing right now.
Oh, absolutely. The costs of everything are up.
Right. Insurance costs are up. Labor is expensive. Usually when costs go up, a company raises its prices. That is just the standard playbook. But Domino's didn't do that in Q4.
This was the big aha moment from the call. It's the difference between pricing power and profit power. In the fourth quarter of 2025, Domino's pricing was essentially flat.
Flat. Zero increase. Which sounds completely insane. If my store's rent goes up and my insurance goes up, but I charge the exact same amount for a pepperoni pizza, shouldn't my profit margins just tank?
You would naturally think so.
Yeah.
But the result was the exact opposite. Despite flat pricing and high inflation, franchise profitability actually increased.
And you need to walk me through that math. How does a franchise charge the same, pay more for insurance, and end up with more money in their pocket?
The estimated U.S. franchise store profitability grew to approximately $166,000 for the year.
Per store.
Per store, yes. And keep in mind, the average franchisee owns about 9 stores. So the enterprise profit for these franchisees is approaching $1.5 million a year.
That is incredible, but how did they achieve that without raising the price of the pizza?
It comes down to driving transaction growth rather than just ticket growth. They focused on order counts. And they did this largely through their Best Deal Ever promotion.
Ah, right, the mix and match deal.
Exactly. It's a promotion that screams value to you, the customer, but it is meticulously engineered to be profitable for the franchisee through supply chain scale and operational leverage.
Operational leverage. Break that down for us.
Imagine you own that pizza shop. You have fixed costs. You have to pay rent, buy the oven, keep the lights on, pay the manager. Let's say that costs you $50,000 a month. Whether you sell 1,000 pizzas or 2,000 pizzas, that $50,000 baseline bill doesn't change very much.
Right, the landlord doesn't care how many pizzas you sell. The rent is the rent.
Exactly. So once you sell enough pizzas to cover that fixed $50,000, every additional pizza you sell is highly profitable. You only really have to pay for the dough, the cheese, and the cardboard box.
So by keeping prices flat, they chose to sell way more pizzas at a slightly lower margin per pizza rather than fewer pizzas at a higher price.
Spot on. That is profit power. The volume of transactions solves the margin problem. It creates this beautiful flywheel. Because these franchisees are happy and highly profitable, they take that $1.5 million and they go build more stores.
Which drives more dominance in the market.
Exactly. More stores mean faster delivery times, which gets more customers, which drives more volume.
But to handle that kind of extreme volume without the kitchen just completely melting down, you need some serious efficiency. And this is where the transcript stops sounding like a restaurant company and really starts sounding like a Silicon Valley tech firm.
Yeah, they spent a lot of time on the call talking about orchestration.
Orchestration and this system called Dom.os. Let's talk about the innovation menu, both the food and the tech.
Well, on the food side, it's important to note their product strategy isn't just about one-and-done gimmicks. The Parmesan stuffed crust, for example, continued to perform really well in both mix and profitability throughout 2025.
And the New York-style pizza is still a key part of their growth, right?
Yes, and we can expect 2 or more new product innovations in 2026. But the tech side is where it gets wild.
The smart dispatch system, I was reading this part of the transcript and I had to read it twice.
It's the orchestration engine within Dom.os. Basically, the system now synchronizes the actual pizza oven with the delivery driver.
Because historically, the bottleneck in any pizza place is the make line. You get an order, you make it, you throw it in the oven. But what if the driver is out on another delivery and won't be back to the store for 10 minutes?
Then the pizza sits under a heat lamp. And the heat lamp is the ultimate enemy of a good pizza. It dries out the cheese, it makes the crust soggy.
So how does Dom.os fix that?
If the system sees that a driver won't be back for 10 minutes, it actually holds the order. It holds it back from the make line screen.
Wait, so the computer refuses to let the kitchen staff make the pizza?
Exactly. The goal is real-time pizza making. The system calculates the exact bake time and the driver's GPS location. It times it so the pizza comes out of the oven exactly when the driver arrives at the store.
That sounds incredibly risky. What if the driver speeds up or there's a glitch? You have a hungry customer waiting at home and the pizza isn't even in the oven yet because the computer said no.
It's a calculated risk, but their data and machine learning are so good now that they can pull it off. They pair this with consumer tech upgrades too, like a relaunched e-commerce site and a brand refresh with new visuals and this new heartbeat sound on the app.
It's fascinating. You're turning a neighborhood pizza shop into a synchronized, just-in-time manufacturing plant.
It really is.
But we have to talk about the other side of the physical business. We always focus on delivery because it's Domino's, but the carryout business is an absolute behemoth now.
It is staggering. Carryout is now a $4.4 billion business for Domino's.
Billion with a B. Just from people walking in to pick up a pizza.
Yes. And it grew 6.5% in the fourth quarter alone. Just to put that into context for you, Domino's carryout business by itself is larger than the total business of 2 of their national competitors.
That is mind-blowing. But why push carryout so hard? Isn't the entire brand identity built on Domino's delivers?
It is, but carryout serves a different purpose. First, the margins are incredible because you don't have to pay a driver. But second, it captures a completely different customer base. It's the loyalty accelerator.
The Domino's Rewards program, I noticed that on the call too.
Right. They currently have 37.3 million active users in that loyalty program. That's up about 20% since they relaunched it in 2023.
And how does that tie into carryout?
Loyalty drives the carryout business. It allows them to capture what they call light users, people who might only order once a year, maybe for the Super Bowl, and turns them into frequent customers. A carryout customer is often looking for the lowest absolute price, and the app rewards them for coming into the store.
Speaking of reaching different customers, we have to talk about the aggregators, Uber Eats and DoorDash. For the longest time, Domino's completely refused to be on those apps. They were the holdouts.
They really were. They viewed them as competitors.
Right, frenemies. But now they are on both. The DoorDash rollout really ramped up in mid-2025. What is the current status there?
Well, management was very transparent on the call. They stated that they have not yet reached their fair share on these platforms.
What exactly does fair share mean in this context?
Think about the broader U.S. market. Domino's does about 1 in 3 pizza deliveries in the entire country. But they are not capturing 1 in 3 pizza orders on Uber Eats or DoorDash yet.
Ah, so they are under-indexed on the apps compared to the real world. That's a huge opportunity.
It's a massive runway for growth.
Yeah.
But their strategy here is very deliberate. They treat the aggregators purely as a marketing layer for incrementality.
Incrementality, meaning getting brand new customers they wouldn't have reached otherwise.
Exactly. If you already have the Domino's app, they want you to order there so they don't pay a commission. But if you are someone who only ever orders food by scrolling through DoorDash, Domino's wants to be visible to you.
But they still use their own drivers, right?
Yes. They keep their own low-cost delivery channel dominant. The aggregator just processes the order, but a Domino's employee in a Domino's uniform still delivers it.
Keeping that quality control in-house. I did note in the financial statements that the company is actually increasing its technology fee by 1 cent per transaction to help fund all these tech investments, including the aggregator integrations.
Right, a 1 cent increase. It seems tiny, but across billions of transactions, it funds that massive Dom.OS infrastructure.
It adds up fast. Now, we've been very focused on the U.S. market so far, but Domino's is a massive global operation. And looking at the international numbers, it's a bit of a roller coaster.
It's a tale of two different worlds right now. On one hand, you have to acknowledge the streak. Their international business has seen 32 consecutive years of same-store sales growth.
3 decades. That is almost unheard of in retail.
It's phenomenal. But the fourth quarter was tough. The overall international comp was only up 0.7%.
That's practically flat. What is dragging them down?
The problem child right now is DPE, which stands for Domino's Pizza Enterprises.
And they are a master franchisee, correct?
Yes. They're a massive master franchisee that operates the brand in Australia, Japan, France, and a few other major markets. And they are severely underperforming.
So what's the action plan there? Do they just wait for the local economy to recover?
No, Domino's corporate is heavily involved.
Yeah.
There is a new CEO at DPE, Andrew Gregory, and the corporate team in Michigan is working very closely with him to turn those operations around.
So mature markets are struggling. Are there any bright spots internationally?
Oh, definitely. China and India are absolutely accelerating.
I think I saw they opened almost 600 net stores combined in those two countries just in 2025.
Yes. The growth there is explosive. And looking ahead, there are guidance plans for 800 net international store openings overall in 2026. So the global footprint is still expanding rapidly, mostly driven by Asia.
Okay, let's look at that 2026 outlook. And something CEO Russell Weiner said that it honestly sounded a little audacious to me. He believes Domino's can double its current U.S. retail sales.
It is a very bold claim.
I mean, they are already the biggest pizza company in the country. There's Domino's in almost every town. How do you double from an already massive baseline?
It comes back to market share. His logic is actually pretty sound if you look at other QSR categories. Think about burgers or coffee. The market leaders in those spaces usually hold 40 to 50% market share.
Right, the top dog dominates half the board.
Exactly. But Domino's, despite being the leader in pizza, is currently much lower. They handle about 1 in 4 pizzas, so roughly 25% market share.
Because the pizza industry is still so fragmented with local mom-and-pop shops and regional chains.
Yes. And Wiener sees no reason why Domino's can't reach that 40 to 50% dominance over time. They have the profit power, The tech stack, the scale. The local shops just can't compete with a system that orchestrates oven-bake times with GPS tracking.
So the goal is to double their slice of the pie, literally. What does the specific guidance look like for 2026 to get there?
They're projecting 3% U.S. same-store sales growth and 6% global retail sales growth.
And what about operating income?
They expect 8% operating income growth, and they plan to open another 175-plus new U.S. stores this year.
Did they mention any immediate headwinds? I know the weather in January was pretty brutal across the U.S.
They did acknowledge that. January 2026 weather was bad, and it definitely disrupted sales early in the quarter, but they factored that into the 3% guidance.
And what about those insurance costs we mentioned earlier?
That is a real pressure point, specifically for corporate store margins. In fact, margins were down 5.4 percentage points in corporate stores, largely due to insurance.
But again, that hits the corporate-owned stores. The franchise model remains fairly insulated because of the profit power and volume we talked about.
Exactly. The franchisee base is healthy enough to keep the overall growth engine moving forward.
It's a fascinating look at how a legacy brand operates today. To summarize, Domino's is clearly playing a long game here. They aren't just reacting to quarterly noise or temporarily raising prices to save a single quarter's margins.
No, they're building a fortress.
Yeah.
A fortress of stores, data, and supply chain efficiency.
The key takeaway for anyone listening is that in a world of high inflation, where you see competitors failing and closing hundreds of stores, Domino's is proving that operational excellence is the winning formula. Profit power, focusing on efficiency and transaction volume over price hikes, is how you survive and take market share.
It's a masterclass in scale.
It really is. But it leaves you with a pretty provocative final thought. Think about this. If Domino's can hold a pizza order inside a computer system, timing it perfectly so it comes out of the oven the exact second a driver's car pulls into the parking lot, are they even a food company anymore?
That is the real question.
Or are they actually a tech logistics company that just uses pizza as a currency? And if they really do double their market share to 50%, what does that mean for the traditional neighborhood pizzeria? Can the romantic idea of the local pizza shop even exist in a world optimized by Dom.os?
It's something you definitely have to wonder about the next time you order.
Something to mull over while you watch that digital tracker move from prep to baking. Well, that is a wrap for this deep dive into Domino's Q4 2025 strategy. Thank you for listening, and we'll catch you on the next one.